Good morning, everyone. Welcome to this update for global stocks and commodities for the 22nd of July. Not a lot happened at the index level during the week. We've got earnings season starting to ramp up. This coming week is going to be probably the biggest of earnings seasons. I think probably something like half of the S&P companies will report over the next couple of weeks. But the established trends have continued. There's still some volatility about, but it is settling down. There's lots of movement in individual stocks that you don't tend to see if you're just looking at the index level. But look, at the moment, everything is going along reasonably okay, and I think we're getting close to the end of this consolidation that started in February, and it looks the probability like the market is about to, or the US market is about to embark on a new leg higher. So let's jump in and look at the detail. So obviously earnings season now is important, and in particular the forward guidance. And another aspect that I always monitor is the sort of normal rotation between sectors in terms of what's moving up and what's perhaps experiencing some profit taking. That's always in play, but it's particularly important around earnings season, and we're seeing a few leadership changes, and I think we'll continue to see that over the next couple of months. So I'm continually looking for evidence of sectors that have perhaps been running for some time and might be getting a bit tired, and others that are starting to emerge that have been languishing a little bit, and there certainly are some opportunities opening up. We'll be looking at the normal stock and commodity trend updates, of course, and portfolio analyst last week was a good session on the feedback that I got. I spent quite a bit of time looking at the tactics in volatile markets. I think tactics are really important. Too many people that I speak to and correspond with just are looking at individual stocks, and they're not really thinking about the broader tactics of the market, or the broader tactics of how can you leave the door open to make profit but still protect your capital fairly closely. And there's a number of things that you can do. And I also did a review of the Australian resource sector. Now, resources other than gold have been getting dealt with very severely overseas, an absolute smashing there. And even in Australia, not looking too healthy outside of the gold stocks. So there's nothing really there to buy at the moment, but I always get interested when sectors that have got a good fundamental outlook, such as copper, which will be in a supply deficit basically from here on in, where the prices are moving down substantially. That just smells opportunity to me, because there's definitely some panic in the market. People are dumping stocks because the prices are going down without really understanding why they're going down. And frankly, I'm not sure I know either, but I just know that if I watch the charts, eventually an opportunity will present itself. So interesting in that sector in Australia. Now, the S&P was essentially flat for the week. I think moved by about 1 point. It went up to about 28.15, so we've managed to sustain the breakout above the 2800 point level, and I expect that it will have a crack at the all-time highs in late January, which was about 28.75. We're starting to see now that whilst there's still a lot of pessimism around about the global trade tariff things, and Trump has now ripped out the kitchen sink and he's throwing that at China as well, threatening to basically put a tariff on everything. Earnings results now are starting to get the market focused on the things that are important. And at the end of the day, earnings are the most significant thing that drive the market long term. Now, Trump had a very busy week. He's got his fingers in obviously the trade tariff issue. He's even having a crack at the Fed. Not in step with their policy, and that caused a bit of a pullback in the US dollar. He's having a fair old swipe at European allies and doing and saying probably the wrong thing with respect to Russia as well. So he had a very busy week of meddling and certainly didn't help things. The market breadth, however, is still good. A lot of people are pointing to the massive gains that we've seen in the FANG stocks, Facebook, Amazon, Google, Apple, etc. And also the poor result from Netflix, which fell about 14% on earnings, or wasn't so much earnings. The earnings were good, but the subscriber numbers, which Wall Street follows very closely, were not as good as they were expecting. So a lot of people are sort of pointing at that as evidence of a market top. It's just not factual. The reality is that market breadth is still very good. So things are looking quite solid there. The US dollar was a little bit lower for the week, and it was really just because of the pullback on Friday, and we've still got a consolidation happening below the 95 level on the US dollar index. Let's look at some charts. We'll start with the S&P on a monthly chart. So this is the bottom in 2009, and you can see that we've had a little bit of a dip this calendar year, but we're almost back to towards those all-time highs. So no interruption whatsoever to the bigger picture trend. Let's look at it on a daily. So we managed to break above 2,800, not definitively. So I wouldn't rule out a pullback perhaps to a lower level. We could pull back to 2770, something of that nature. That wouldn't change anything at all. I really think the next leg up has started. That's on a medium-term basis, and we'll see a challenge of this 2872 high at some stage in the next couple of months, I believe. That's what all the signs are sort of indicating to me. The Nasdaq remains very strong, which is a real positive, set a new all-time high on Tuesday. And also the Russell for small caps, Russell 2000, is just a whisker off its all-time highs that was set in June. And despite the weakness in the S&P throughout March and April, the Russell just powered to new highs. Very impressive performance. Okay, let's move on. The Aussie stocks, the Aussie dollar, slightly higher, and that's just really the US dollar coming off on Friday night. And we'll look at those currencies in a minute. It's just consolidating between 73 and 75. But with the Australian 10-year bond rate now below the US, it's very hard to see the Australian dollar going up very much from here, unless there's a complete reversal in the US dollar fortunes. The ASX 200 rose by 18 points on the week. We saw materials and energy sectors were down. That's with commodities, and we saw banks higher. But the real stars of the Australian market in the last few weeks have been the financial technology stocks that are absolutely killing it. And members, of course, are all over that and have done extremely well in several fintech stocks this year. So may that continue, and the signs are certainly looking very, very good. So let's just take a look at some currencies now. Look first of all at the US dollar. So we've got this big consolidation happening here within an inclined upward channel. Just having a little bit of trouble breaking clear of 95. And of course Friday was about Trump having a crack at Fed policy. Wish he'd stick to things that he actually understood. The Australian dollar, as a consequence, did a bit of a gap up on Friday. So we've got a consolidation here between 73 and about 74.5. But clearly the trend is down. The 200-day moving average has rolled over, and the price is significantly below it. So we seem to be in an accelerating downtrend in the Australian dollar. Precious metals, gold was down another $11, but it was down more than double that at one stage to 12.31, but I think it got down to about 12.15 at one stage. And I mentioned last week that $1,200 was absolutely in play. So we saw a big breakdown. A couple of weeks ago, we broke out of the trend channel, and now we've broken key horizontal support, and that really precipitated some accelerated selling. Before we saw a bit of a rebound on Friday, and that's really just currency. That was the US dollar coming off. So it would appear that $1,200 is still absolutely in play, and that looked very unlikely just a few weeks ago. So it's been quite a dramatic shift in the gold price. And with interest rates going up and the US dollar strength, gold really doesn't stand a chance at the moment. Precious metals, there's far less impact on the gold stock. So even if we look at GDX, which is all the gold majors, it's really still in a sideways pattern. It's really not doing anything. It didn't move up in advance of gold, and it didn't move down in advance of gold going down either. So it's really just sitting there spinning its wheels. Let's take a look at the precious metals market. So there is the gold chart. Here's the horizontal support that was broken at 12.38. So we got down to that level, double bottom. We had a bounce. The bounce was fairly short and weak, and then we've broken down from that level. I think 1,200 is, and just below, is still very much in play. And you can see rebound on Friday, so we may get a retest. We may get up to the mid 1230s, but I fully expect this to turn down again. And there's the weekly chart. We've clearly broken this uptrending channel that had been in play for quite some time, since the end of 2015. GDX, not really doing very much. As you can see, this is a weekly chart, and despite the fairly sharp move in gold, it hasn't really changed much there. Other commodities, copper eased again down to 278, and it's just been a horrid month for nickel and zinc and copper and lead, and it's really pointing towards a recession is really what the copper price is telling us, but that is completely at odds with the supply and demand fundamentals, which for several years have been clearly heading towards a supply deficit. And unless demand absolutely collapses, and it's pretty hard to see that happening, then we're going to have a supply deficit basically from here on in, and it's really very puzzling as to why copper is acting as it is now. Okay, part of it is strength in the US dollar, but the move down in copper has been more than just currency impact. So it'll be interesting to see how that plays out. Crude oil dipped again sharply, got down to I think about 67, 66, but rebounded a little bit on Friday. Energy stocks seem to be ignoring the fluctuations. So fairly similar to the gold sector, really. The stock's not leading the way at all. But I do note a very significant divergence in the energy sector between the stocks that are leading and the stocks that aren't. It's quite large, the differential. So let's jump in and just check in on the energy chart. I'll just get to, there we go, XLE, which is the US energy sector chart, and you can see this is on a daily basis, but certainly not looking anything like the crude oil chart. We've had a bit of a move up, but isn't really responding, which seems to indicate that, certainly at the index level, that a lot of players are not expecting the oil price to hold its current strength. We'll see. But as I mentioned, there are energy stocks that are significantly outperforming, and they're trending up very, very nicely. There's the spot copper chart. You can see a little bit of a turn up in the last day, but it's been a very, very steep decline from 330. Crude oil over the last 3 months, you can see we dipped to 67 through the week before bouncing to 68 and a bit. It looks like very, very choppy trading, but if we look at the 12 months chart, you can see unquestionably there's a very clear trend there that has not been violated yet. And until it does, then that's what we should stay with. So to wrap it up, there is the strong possibility that the next leg higher has begun. That's not to say that in the very short term, in the next few days or week, we could see a bit of trading below 2,800. That would not be abnormal at all. But getting outside that very short-term movement, I think the next leg higher has probably begun. And I'm still very much of the view that we'll see the indices higher and new highs by the end of the year in the S&P. The biggest danger, I think, to traders and investors is that you get emotionally involved with the volatility. It is so important to learn about tactics, which is something that I started touching on in Portfolio Analyst last week. Learn how to protect your capital while still leaving the door open for ongoing profit. And there are many things that you can do that most people are unaware of that allows that to happen. And this is a sort of market where you've got to do that, because most people are just not emotionally resilient enough to the sort of volatility that that comes along in these sort of markets, and I don't think that's going to change. Watch out for the out of favour former leaders. The Chinese stocks, Alibaba and Tencent, have been really struggling. A lot of other Chinese stocks have been hammered very hard, but the fundamental outlook is still positive. The fundamental outlook for US financials is still positive, but they've had a very lackluster year so far. I'll show you a chart of that in a moment. So watch out for those former sector leaders, because they could have just gone through a period of being out of favour, and will pick up that leadership again. Portfolio analyst this week, I haven't determined as yet for the next edition, but I'll advise on that. Let's just look at as an example, at the XLF in America. So just get to XLF. So here's the US financial sector. So we had a big consolidation here. We started to move in November of 2016, which actually started moving a couple of days before Trump's election. We then went into a very powerful uptrend that took the overall finance sector from 22 to 30. We've now had a consolidation that's now formed up a very nice wedge. This support is holding. Really want to see a bit of a breakout, want to see it get above 28. But the fundamentals are really quite positive for the financials, and the earnings results that have started coming through have been really good as well, particularly Bank of America, Morgan Stanley, JP Morgan have all done quite well and beaten expectations. So I think the finance sector is one that could be a happy hunting ground in coming months. So that's it for this edition. There's my contact details for any non-members, and I'll be back with you next Sunday. Cheers.